Hello and welcome to RCLCO's March macroeconomic update. I'm Scott Bommarito here again to give you a couple quick updates on what's going on in the economy. Starting first with the inflation report from February, we saw some continued positive developments overall with annual headline and core inflation both holding steady at about 2.4 and 2.5% respectively. That's similar to the rates that we've seen over the last couple of months and certainly an improvement from the last several years of elevated readings, although they remain modestly above the Federal Reserve's target level, but certainly positive developments that we expect to continue in the midterm, even if there's some disruption in the near term, which we'll get into more momentarily. Looking at the component breakdown of the CPI report also brings some positive news, particularly as shelter's share of CPI has moderated and is now near its historical average. For the last couple of years, shelter prices were really what was driving elevated inflation, and thankfully we've seen that turn a corner and now start to correct. That said, the biggest risk on the near-term horizon is an energy price spike that we are already starting to see in the real-time data, and we expect that to drive a boost, at least in the March numbers, and then we'll see how that progresses in the coming months, depending on what happens with the US's war in Iran. The biggest macroeconomic impact, of course, will be via Brent crude oil prices, which we've seen skyrocket since the conflict began a couple weeks ago. Oil prices rose up to about $112 per barrel. They've moderated somewhat this week. They've come down and they're hovering at about $100 as of the time of this recording, but we expect continued volatility in oil prices as the conflict drags on, particularly as long as the Straits of Hormuz remain closed to oil shipments. If the Trump administration is able to negotiate some kind of ceasefire or some kind of reopening of the Straits of Hormuz, oil prices will likely come down fairly quickly, although it remains to be seen what the timeline would be on the end of this conflict. That's also been playing out in interest rates, where we've seen the 10-year US Treasury rate increase over the last couple of days and is up to about 4.4% today, a little bit higher than it has been recently. Most forecasters continue to call for the rate to steady at near 4 to 4.5%, somewhere in that range over the next couple of years. That's where the 10-year has been over the last several years and seems like a good baseline going forward for forecasters. Still in that range as of this week, but toward the higher end of it rather than the lower end of the range. The Federal Reserve had held rates steady in March, and the outlook is uncertain, and we expect it to be even more uncertain given the war in Iran and the uncertainty going on there. This could argue for either more rate cuts or for a longer period of holding rates steady, depending on what macroeconomic impacts we see the war have. On the one hand, if oil prices continue to rise and stay elevated as we saw in the prior chart, that could lead to a broader inflationary spiral, which would then argue for holding rates steadier at their higher level. On the other hand, if the war begins to have more economic impacts on the downside, either through employment losses or through growth slowdowns, that could argue for further rate decreases over the coming months. So continue to be data dependent on this. The commentary coming out of the last FOMC meeting was very much mixed, and the Fed continues to try to hold their cards close to the chest to maintain that optionality depending on how the data develop. Another data point that will impact the Federal Reserve's rate decisions at its coming meetings is the employment sector. We saw monthly employment decline slightly in February, down just about 0.1%, but still some job losses. And we saw those job losses across a wide range of sectors. The education and health services sector, which recorded quite strong job growth over the last year, saw some job losses, mainly due to a healthcare strike. over the last month. So we expect those losses in that sector to be modest and short-lived. On the other hand, in the information sector, we saw continued job losses over the last month, and that's been the story over the last year as well. So continued pressure to a large degree from the impacts of AI in the information sector. So we'll continue to develop how the employment trends shake out and what that will mean for interest rates going forward. That concludes our March macroeconomic update. I'm Scott Bommarito. Continue to follow RCLCO for more updates and relevant webinars.